Hello, my name is Marco Trombetti and I'm the CEO and co-founder of PyCampus. I started as an entrepreneur almost 20 years ago. I founded Translated and Memopal, and with the profit from this venture, I started PyCampus, a venture fund. Today, what I would like to share with you is one topic, that is how to pitch to investors. The reason why this thing is very important, and because it's the first step in your startup creation. It's not only about pitching to investor, actually. A good pitch will help you find co-founders, employees, and if you adapt the pitch a little bit, also your first customers. So the reason why I'm doing this is that I think that pitching an idea is easy, but only if you know how to do it. And unfortunately, there is very few opportunities in your life to learn how to pitch. In fact, most of the time, when you go out and pitch to someone, at best you receive a feedback about the idea and not the pitch itself. So there is no way you can learn and improve. Too few cases, too few feedback. So I think I'm not very good at teaching you how to pitch for later stage investments. I have no experience for later stage pitching, but I think that I have a good experience in early stage pitching because I've seen from 2,000 to 3,000 pitches in the last 6-7 years. So I'm a lazy person, but also a fast thinker, and I spend a lot of time trying to think what is the shortest possible pitch that can convince me to invest in the shortest amount of time. And so sometimes founders come with redundant information that is boring. Sometimes they miss very key important information that investor needs. So the idea here is try to identify what are the elements that are necessary and sufficient to deliver this pitch to convince an investor. So after some work, I came with these 5 points, simple 5 points. Sometimes I will refer to slides, but really you can do 5 slides, you can do a small text of maybe 100 words, 20 words for each point, or a verbal communication with someone that can last from 30 seconds to 2.5 minutes, 3 minutes maximum. And yes, shorter is your pitch, better is. In fact, I don't recommend at all having pitches longer than 5-6 minutes. And I think that the ideal point would be something very short, between 30 seconds and 2.5 minutes. By doing that, you can deliver the information that are required to gain the attention, make sure the person is interested and discovering so the person can discover what you're doing. So the 5 points are very simple. The problem, the solution, the market, the traction, and the team. So let's start with the first point, the problem. At the very beginning, you want to start by not talking about what you do, but what is the perceived problem by the user. The reason why you want to start with problem is also because you want to create empathy with your investor. And it doesn't know nothing about the problem. You do because you're working on it, but you want to make sure that he understands what you're trying to achieve before what you actually did. There is also another reason why founders always talks about the solution is what I call creation ego. We want to talk about what we do, and we love to do that, but that goes totally against the interest of interesting someone else. Making someone else interested in what you're doing. So the problem needs to be a perceived problem for which the user is going to take an action to solve it. And the action can be spend time or paying a premium amount of money for the solution. And again, I stress perceived. Many startup founders come with problems that are not perceived by the user, or if they are perceived, they're not perceived strongly enough so that the user will take an action to solve it. And so let me give you an example of a problem that is not perceived. For example, if you say, computer breaks, so here's the beautiful computer insurance for your computer. And you know, it's true that at one point the computer will break, and after 5 years or 3 years or whatever, but it's not a perceived problem. When you use the computers every day, you don't think about the computer crashing. You think about other problems that happens every day on your computer, and that's the perceived problem. So you don't want to start with something that is not perceived by the user. Make sure that the way you're expressing your problem, make sure that is understood, that it's perceived by the user. Some founders will say, you know, I want to build a company and then I will do marketing so that the users will understand the problem that I'm trying to solve. And that's a very bad idea. I know where they come from. They come from looking at very large monopolies like Google, Apple. They're doing certain things. So they're so big that today they can kind of influence the audience. But for a startup, it's very different. And in fact, managing a monopoly is something completely different than creating a new company. And you are in this second case. So once you're done with your perceived problem and explaining this, you can go to the next phase, the solution. In the solution here, you have to explain what people are doing today to solve the problem and why your solution is better than what they currently do. And here's a trick. If you're not able to describe what people do today to solve the problem, and if that doesn't seem painful, I think you need to go back to point one, because your problem is not perceived enough so that they're doing something. So if it's something completely out of the blue, it's not going to be successful. And even the best success, this disruption that you see, start by a perceived problem where people are taking an action which is painful. And then you build something which is innovative and create a big gap previous to the previous solution. But you need to have people that are doing something already to solve the problem. So once you're done with that, you have to explain your solution why it's incrementally better. Okay? And I want to tell you maybe one example here. So how I failed, for example, in 2007 I created a company called MemoPal, 6 months or 1 year before Dropbox, doing exactly the same thing. Dropbox is worth 10 billion today, and MemoPal was sold for 2.5 million. And when we started, we had much more money than Dropbox in the bank, but they became better. And one of the reasons is that because they were able to focus on the perceived problem from users and not what we felt was the problem we wanted to solve. And I give you an example. So we were focusing on the backup. So we knew that people were leaving stuff on their computers and that files were lost at one point. And so we're saying, wherever is the file on your computer, we'll back it up, and $50 a year, all your files are in the cloud. And even if this was a kind of good solution for the problem that we felt existed there, so users not losing files, Dropbox came with a slightly different value proposition that was more focused on sharing the files rather than backing up the files. So one was backup, the other one was sync. And obviously in Dropbox, if you don't put the file in the folder, that file will not back it up, will not save. So in a certain way, it's not solving the problem of protecting, but is what people wanted. And so also Dropbox value proposition was about sharing large files that at that time, why it was perceived, because it was really problematic. So at that time, Gmail, for example, allowing you only to have an attachment that was 10 megabyte or 20 megabyte. And so if you had a bigger file, people were actually splitting the files into chunks and using the software on the other side to build it back after you send it. Very painful. Or some other people were setting up FTP servers to solve the problem. And not all the people are able to set up an FTP server. So you see there is a perceived problem, I'm not able to share file, and people are doing an action. They are doing painful things like installing software to split files and then recombine the file afterwards, or setting up FTP servers. And what Dropbox did is that, okay, you right click on the file, you obtain a link, and you can share the link with your friend. As easy as that. So you see, that's the right way to describe your problem, to describe your solution. So problem, solution, and then we need to go to market. Why market is super important? Because it's the opportunity, it's the impact that you will have with your startup. I strongly suggest that you pick a market that is bigger than $1 billion. And I will tell you with a math example. So you need to be interesting for an investor. And a venture fund works where we lose money 9 times out of 10. And in one time where we actually find the right solution, we need to make at least 30 times the investment in order to cover the losses. So if you do so, after 7 years, 8 years, the times of the fund, you have basically 3 times the money that you invested. So every single opportunity we invest in needs to be an opportunity that at least brings 30 times the money. And so at one point your startup will raise 10 million, let's say a $30 million valuation. And when you do so, that startup needs to be worth potentially 1 billion, 30 times 30 million, 900 million, so almost $1 billion. And so that investor is looking for that return. And you have to show that the opportunity, that the market where you're in is as big as that. If it's smaller, then it would be not a suitable investment very often for venture capital. So, and I strongly recommend to be much bigger actually than 1 billion. And the reason is simple, because you will make mistakes and you'll not be able to conquer the entire market opportunity. So you have to leave some room for those things. And how you come to the number of the market size is simple. Well, you can go and do some research on the internet. That's the easy way. What I don't recommend is to look at what market research companies do. The methodology I suggest is called a total addressable market. It's very simple. You take how much your product is worth or service, and you multiply that by the amount of possible users for that service, the people that are interested in that solution. It's a simple multiplication. And some market research company will do something different. Will give you a report and say, cloud storage is worth 20 billion. And why this is the wrong approach? Because they always underestimate or overestimate the market. And I give you the 2 examples. If you ask a market research company 10 years ago, what is the market for short-term rental of houses? They say it's almost 0. And then Airbnb comes with a $50 billion company. So they totally underestimated the market because the market didn't exist. And actually what Airbnb did, moved people from going to the hotel to the house. So it's a substitution business. And they created something that was not predicted by the market research. But if you were applying total addressable market, you say, okay, I make $20 in reservation fees for every house on average, and I have millions of people traveling. Oh, here's my multi-billion-dollar market. The other way market research companies are making mistakes is because they overestimate your market. And I have this example from a startup in Italy that came to me a few years ago. They say, we develop software for supermarkets. And Gartner estimates that the supermarket software market is worth 2 billion just in Italy. And I told them, so how much are you selling your solution for? Which was $1,000 per month. So it makes $12,000 per year. And how many supermarkets are in Italy? 10,000. So your market is 120 million total, even if you capture every single supermarket in Italy. That's very different from 2 billion. And why Gartner was telling this number? It's not that the number is wrong. It's simply that they put together every single piece of software that the supermarkets will buy. And you are making something very specific. So try to use total addressable market. Pick a market that is multi-billion-dollar market And if your market looks too small, go back to point number one and problem and try to open a little bit the scope of what you're doing. And if by opening the scope, also the perceived problem becomes less, because more you're precise, more it's easy to identify a perceived problem. And so if you open too much and then the perceived problem goes down, but you reach the market size, you're still in the wrong position and you want to go back and maybe pick a different problem. So it's a puzzle that you have to make between how much the problem is perceived and the market size, and you actually need both of them. So once you're done with market, the next slide is the most important slide, and a slide that everyone gets wrong, and the great founders typically make this slide the most important for them. And normally, the people that get it right only need that slide to convince an investor. Traction is how much you're growing over time. What you want to show is that you're moving fast. The best way to show traction is showing the revenues per week that are growing around 5, 6, 7, 10% week over week. Why this magic number? Because if you start with $1 revenue at week number 1, after 5 years of 6.5% growth for 5 years, at the last year you will be making $1 billion per year. And that's the magic of exponential growth, or if you want, compound growth. You want to show the investor that you are that company that is growing continuously at that rate. The best investors are able to recognize exponential growth at the beginning. Not because they look at the graph, which looks like flat in the beginning, but because they are able to read the numbers and see that if for 8, 9 weeks you're keeping that growth, it means that you have something that people want. You have something that people buy and are recommending to other people. That's the secret of exponential growth. So, in some cases, you don't have revenues yet, okay? So you can do this with users, for example, or you can do with letter of intents or other means. And very often, the founder comes to me and say, Marco, I'm not able to show traction because first I need the money, then I build a solution, and then I can show the traction. Because if I don't build what I want to do, how can I prove that people want? And that absolutely false. So in software, to come back to the example of Dropbox before, Dropbox recorded a video of what they were doing and pushed the video on Dig, a social network. And from there, they started receiving people that wanted the solution before actually it was even launched as a private beta. And so you look at how much the private beta users are growing, and that's an indication of traction already. So you don't need even to build a software to do it. Some other people said, but we do hardware. So we have hundreds of thousands of dollars of manufacturing just to start. And if you don't build something, you cannot really prove the traction. False again. Kickstarter, Indiegogo, these are great platforms for discovering this. And this is called pre-orders, if you want. It's not really a crowdfunding platform. What they do really provide as a service is validation. And so use those, create a nice design, industrial design of the product, provide the specs, define your offering, and go out and see how many people want it. If nobody wants it, it's not a perceived problem, and you can go back. So some of the founders will come to me and say, but we're building an enterprise solution, so there is not a platform where I can go and sell my solution. I need to build it. And actually, I'm building a supersonic plane, a new Concorde, so I'm not able to show traction at this stage. I first need a few hundreds millions of dollars to build it, and then I will see if this works. Again, this is false. And the person that proved me that this is possible is called Blake. Blake is the founder of Boom Supersonic, one of our investments. So what Blake did is created a nice rendering of the plane, having the specs ready and the cost, 200 million, and he was going to visit airlines to ask them if they wanted to sign a non-binding letter of intent for the plane. In 3 months, Blake, after many iterations, collected $5 billion of letter of intents, that months later became $20 billion of letter of intents. And so when people were getting interested in the plane, because they really wanted, some of those companies converted the letter of intents, non-binding, into orders. And that's how the company started from raising a few hundred K, 5 million, 33 million, hundreds of millions. And that's how you grow the company. First you show the traction, and then you raise the money. The other way is non-convenient, both for you and for the investor. The right way to do it is invent a way to show traction. That's where you have to put your imagination. Invent way to show traction at early stage. That's the best thing you can do. So the last point you want is team. But before I go to team, I need to stress something more on traction. So many times after I explain traction, I receive slides of people telling me what they will do in the future. And again, I repeat, traction is not the plan for the future at all. Traction is what you already have done. You don't have to come to show that in the next 3 months you will do this, this, and this. You want to tell the investor what you already did. Show velocity, speed, the fact that things are moving fast, with users, revenues, letter of intents, wherever. But show that people already are interested in what you're doing. Don't talk about the future. So, team. In this slide or a few lines of text, you want to tell the investor that you are the best people in the world to solve this problem. And when I say this, people say, okay, I will never be the best person. There is 7 billion people. But what this really means is what the Greek were calling this kairos, the alignment of the stars. You want to tell the investors that this is the time for this problem, and the people that are working on it are magically the people that together in this time are the best people to solve the problem. So the best way to show you this is to give you an example of a company that pitched to me years ago. So I'm changing the story a little bit for the purpose of education here, but this one day I hope could be a startup. So I will do the pitch from the beginning, and then we go to team where we want to focus. So problem. There is many people in wheelchair with handicap, but they love to travel, and today they're not able to travel because very often they need a friend to come with them to help with the luggage, or they have to take the luggage with them, and bring this on the leg, which is very impractical for security in airports and many things. So they really want to do it, they really want to travel, and today they're solving the problem by inviting friends or trying to bring the luggage with them. So our solution, we build racks for wheelchairs. So one simple thing where you can attach your bag to the wheelchair so that you can in the back and you can bring it with you. And this costs $200. The market is simple. There is 5 million people worldwide that are traveling in wheelchair, and we sell our product for $200. This is a $1 billion market opportunity. Traction. We created the first five racks by hand, and we sold them into a conference in one day, all. Just afterwards, we hired an industrial designer and we created a nice rendering of what the final rack will look like. We put it in on Kickstarter and we raised $150,000 of pre-orders. You're showing the velocity and the traction. This is happening quickly. And there is interest. Last point, the team. So why we are the best people in the world for this problem? I have been in wheelchair for the last 10 years. I understand the problem and I'm strongly motivated to solve it. And my co-founder has been working in Mercedes designing rugs for the last 5 years. So two simple people. One that deeply perceives the problem and have a motivation to solve it. The second one that knows how to do it. The two mix, this simple mix, is what you want to communicate to the investor. So to summarize, some words about the problem, why it's a perceived problem, the solution, what people are doing now and why your solution is better than that. The market needs to be a multi-billion-dollar market, and don't look at research companies, like do what your product is worth multiplied by the number of people that can buy it. Traction. Don't talk about the future, show that you're moving fast, and in the past weeks you have been growing continuously. And last thing, team, show the kairos. Show that there is a perceived problem now and you are the best people in the world to solve the problem because you understand the problem and you know how to solve it. And in the pitch that I just told you, I think it would last maybe 30 seconds or something like this, and you don't need more from an investor. So if you have a pitch that survives all these tests and puzzles, please send it to me, and I promise I will reply with a yes or no on investment in the shortest possible amount of time, surely less than a week. So good luck with your pitch, and I hope to meet you.